Good afternoon. Thank you for tuning in today. Happy International Women's Day. I am Xu Shen, a member of CFA Society San Francisco and part of our Member Programming Advisory Council. It is my pleasure to welcome you to our Fed versus Investor Navigating Uncertainty webinar today. Our session today will be moderated by Ken Fryer, Chief Investment Officer from Atlas Capital Advisor, and Tom O'Shea, CFA, Director of Investment Strategy from Innovator ETF. A quick item note to note before we start. You will be muted for the event, so we encourage you to type question in the Q&A box. We'll monitor the questions closely and aim to have as many answered as possible. This event will be recorded, which we'll share the replay. Now, let's get to know Tom and Ken a bit more. Ken has over 30 years of experience as an institutional investor, have been the Chief Investment Officer of Walt Disney Company, Hewlett-Packard Company, Stanford Management Company, and the UAW Retiree Medical Benefit Trust. He is currently the CIO of Atlas Capital Advisor, a San Francisco-based RIA, and a member of the Investment Advisory Group of Alaska Permanent Fund. His career includes extensive research, writing, and speaking on asset allocation and investment risk management. Ken graduated with honor in mathematics science from the University of North Carolina, Chapel Hill, and has an MBA from Stanford, where he was a J. Miller Scholar. Ken is also an active member and volunteer with CFA Society San Francisco. Joining us today, we also have Tom O'Shea, who joined Innovator Capital Management in 2022 as the Director of Investment Strategy and is responsible for investment research and portfolio construction. Previously, he was a senior consultant in Ernst & Young Strategy and Transaction Group. He spent the majority of his career at Northern Trust Asset Management as an investment strategist on the Global Asset Allocation team. Mr. O'Shea holds the CFA designation, is a member of CFA Society of Chicago, and holds a BS in Finance degree from University of Illinois Urbana-Champaign. He expects to complete his Master in Analytics degree from Georgia Tech in spring of 2024. With that, I'll pass over to Ken to lead us into today's conversation.
Oh, thanks you very much for the introduction. I'm just the moderator here. I am going to turn this over to Tom, who has prepared some slides for us. And when Tom has finished his prepared materials, I hope there'll be a lot of questions from the audience. Please do put them in the chat box. We have some questions that we received in advance as well. So over to you, Tom.
All right, thank you everybody for such a great introduction. I'm going to get started talking a little bit about Innovator first and what our company has brought to the table before I dive into what the Fed and investors, the dichotomy going on there and how to navigate the uncertainty around the interest rate environment and where to position portfolios. So starting first with Innovator. Innovator was founded in 2017 by Bruce Bond and John Southard. And anybody familiar with the ETF industry, maybe those names ring a bell. Bruce Bond and John Southard are pioneers in the ETF industry and started PowerShares back in 2003. And PowerShares ended up growing to be the fourth largest ETF provider in the world that was purchased by Invesco. And what PowerShares really pioneered was smart beta type investing, or many people know this as factor-based investing. So after PowerShares was purchased by Invesco, Bruce and John ended up retiring and had a 10-year non-compete. And many people would probably argue that the ETF industry has matured over that time period, but around 2016, 2017, one of their financial advisors was talking to them about structured notes and annuities as a risk management measure in their portfolios. And they thought, these are some interesting products, but we really don't like the tax inefficiencies, really how difficult it is to sign up for another annuity or structured note after the time period ends, and just the high fees in general. So they started brainstorming and they thought, we did this in the ETFs back in 2003 where we pioneered something, we can still innovate now. And that's what they did. They used basic option structures to provide these defined outcome payoffs. And now they have the largest lineup in the world on the S&P 500, MSCI, EFA, emerging markets, Russell 2000, NASDAQ 100, and also some bonds. So a lot of people may or may not be familiar with Innovator or defined outcome ETFs, but I think after the last 2 bear markets and seeing how our strategies have performed, it'll be a foundation for risk management going forward. Since the beginning of January 2022 to the end of our most recent February, we've seen 11 billion in flows in defined outcome type ETFs. And it's really doubled the assets under management in the industry. So let's basically give a quick scenario analysis on what these strategies can offer. And I think that'll be really helpful as we position portfolios amidst the uncertainty going forward. So we have a couple main different strategies, 9% strategy, buffer strategy, 15% and 30%. And here are just a couple different scenarios on what your payoff profile would be based on what the underlying reference asset does. So let's just ignore the market goes to zero scenario because that's very unlikely. But in COVID, the markets were down 30% measured by the S&P 500. So our 9% buffer was only down 21%. Our 15% buffer was down only 15%, and our 30% buffer was down -5%. So the 30% buffer works a little bit differently because we end up selling calls on the upside to provide that downside protection, and the payoff profile was more, appetite getting if you shifted that down from -5 to -35%. So in a normal market correction, that's only down 10%. In the 9% buffer, you're down 1%, 15%, you lose nothing. And then again, the first 5%. So the scenario when markets are up 7%, you're seeing a 7% gain in all of those. And then this is where you're seeing the caps come in when you sell those upside calls. So if you have a 9% buffer, that's less protection. So you can have a higher upside cap. So in the instance where markets go up 30%, you're seeing an upside of 25%, and that strategy is capped out. For 15%, you're paying for more protection, so you have less upside and you're only getting 17%. And finally, the 30% buffer with the most protection provides the least amount of upside. We hear the phrase, there's no free lunch, and that's true of these strategies, but they've really shown in the last 2 bear markets that they performed as anticipated, and the defined outcome nature has really played well with the behavioral nature of investors who want to know if the markets go down X amount, I can anticipate this and still have a potential for upside depending on what the interest rate and volatility environments are. So let's dive a little bit deeper into the options payoff. If you're a nerd like me, you'd really enjoy to see how these are constructed. So the first layer of the buffer construction begins with the reference asset. So we want to have that exposure of what would it be like to just be invested in the price index of the S&P 500. So what we do is buy a deep in the money call option. And by going so deep in the money, you're paying very little for it. And the reference, your movement will be very much like the S&P 500 because you're so in the money. The next layer is the downside buffer, and you're buying an at the money put option, and you're also selling an 85% strike put option as well, assuming this is a 15% buffer. Now, the third layer is the upside cap. And in addition to the sold put option, this upside cap is selling a call option to fund the downside protection. And this is to be determined, again, on volatility and interest rates, which really drive options prices. So each year when these are renewing, we have to determine at what level of call option do we need to sell, at what strike, to create that 15%. So at each year, that may change. Now that we have that found.
I don't know if you have this off the top of my head, but I think the audience would have an interest in knowing sort of what the numbers are here. That is where the call strike might be. So we're buying a put at the money, right? We're selling a put that's 15% out of the money. And so that put spread has a cost, a net cost. And so what call do we have to sell in order to finance the put spread?
I don't have those numbers off the top of my head. Maybe that's something Bennett could take a look at, and then we could revisit at the end of the presentation if that works. So now that we have that foundation, understanding how these strategies really work, and again, I think these are really foundational for portfolios looking for risk management, especially a year like 2022, where there were points where people were saying that the bond market was more volatile than Bitcoin, and that's just, very unlikely event. But in a situation where rates remain elevated, we know if markets go down a fixed amount, we're protected at a certain level. And I think that is something that all investors can get behind. But let's look next at what the Fed is expecting, what investors are expecting, and really whose side should we be on. So this slide is one of Innovator's themes for the year and what we really expect going forward from an interest rate perspective. And those two slides, I'll get into what each of them mean, but we've really seen a push and pull between what the Fed officials are seeing and expecting and what the markets are expecting. So before the latest Fed funds, before the latest labor market report, we saw the markets expecting rates to go high and then cuts in the back half of the year. This slide, funny enough, is updated through the end of last month, but we've had some more data and it's already stale. So who should we really believe? The Fed is still fighting for a little bit of credibility, right? Because a lot of people were saying, hey, the Fed was really late to this party. They were sleeping too long and their inflation is transitory camp. So they had to hike rates at a really fast pace. So really, who do we believe? What should we expect? And that credibility, I think, is something that all investors have to kind of balance in their head is, it seems like there's time periods where the Fed doesn't really know what they're doing. But then once they start committing to a phase of tightening or cutting, if you will, it seems like they're consistent with that. And that's Innovator's belief that they think inflation is trending in the right direction, but will be really tricky and a bumpy ride. So we think their messaging is consistent and likely to be accurate moving forward. What does this chart on the right show us here? So I think all of us can agree that trying to predict anything in the future 1 year out is a really challenging thing to do, right? What are rates going to do? What is the yield curve, equity markets? What is my March Madness bracket going to look like? But one thing we researched at Innovator is how good is the Fed funds rate, or how good are markets at predicting the actual Fed funds rate? And when you look at 6 months prior, you could see that the markets actually do a pretty decent job of predicting the true Fed funds rate, but they still have a tendency to underestimate during tightening cycles and overestimate during cutting cycles. And I think we could all agree also that this isn't the greatest time span. I would love to have this data going back further. We could all send angry emails to Bloomberg on that if you want. But I think, going off this, we expect this trend to continue in the future. And, we really think restrictive policy is required because of the Fed's hyper awareness of what has happened in the past hyperinflationary periods. So looking at our next slide, this really dives back into history. And at Innovator, we really like to look at what has happened historically as a guide for the future. And anybody that's had to deal with compliance knows that fun phrase, past performance is not indicative of future events. But I still think it's important to say, okay, what has happened historically and what is different now that may make this not be the case? And we know the Fed is hyper aware of this high inflationary period of the 70s and 80s. And if you look at that green line, that is the Fed funds rate, and the blue line is inflation. So each of those 4 distinct time periods, we're seeing the rates cut, and that blue line continues to trend higher. And it takes a while for inflation to move back towards that 2% target. Nobody likes a Monday morning quarterback, but if the Fed maybe were to continue hiking rates at a slow pace, or even just maintain the restrictive policy in 73, 74, maybe they wouldn't have had to eventually climb up to that 20% rate. So that leads us to believe that even though inflation is trending down in the correct direction, even if it reaches that 2% target, we think there's going to be a time period where the Fed sits and waits and said, hey, is this really going to stay down here, or is there some kind of spring action that's going to make it come back out of the box? Again, this is, one scenario in the US. So we like to take a full world view and get as much data as possible. And our research has shown that looking at all the developed market economies from 1980 to 2001, when core inflation has exceeded 5%, it's taken from 3 years on the low end to 30 years on the high end for those rates to come down to that 2% target. So where are we in this scenario? Some people might think it's faster because we're going at such a fast pace, but really it's tough to tell because every tightening cycle is really different.
Yeah, I think one quick thing that also, if you can go back one slide time, one other thing that is worth noting is the relationship of Fed tightening cycles to recessions. Here you have the recessions shaded in gray, and so Fed tightens in each instance of tightening, there's a recession. And I believe it's more than 80%, isn't Tom, something like that? 80% of the tightening cycles. There's only like 2 tightening cycles since World War II, I think in the mid 80s and the mid 90s, where the Fed tightened policy and there wasn't a recession.
Yeah, it's definitely an important note. So now we talked about the Fed funds rate, Fed policy rate, but what about interest rates in general? So again, using history as a guide, we looked at what the 10-year did during all the prior tightening cycles. And that green bar is showing that over the entire tightening cycle, you've seen interest rates increase, right? The median number, which may or may not be relevant, is 1.7%. But I think the more important fact is that it has increased every single tightening cycle for which we have 10-year US Treasury yield data available. That makes sense. That's to be expected. I mean, the 10-year, it's not as tied as closely to hiking interest rates. There's obviously other factors like what's going on with the balance sheet, foreign investors, economic growth, but that's kind of expected. Looking at the back half of those tightening cycles, again, you see 100% of the time for which we have data, that 10-year Treasury yield increases. And then the last 3 months, again, the majority of them, we've seen an increase. It's a bit of a mixed bag, and that could also be expected because markets are forward-looking in nature. So at that point, maybe most of the market participants were saying, "Hey, it's expected that the cutting might start happening soon, or they're not going to tighten any further." So using history as a guide, this is another reason we're really in the camp that rates are going to remain elevated for a while. This is a great illustration of the Fed's tools. So we talked about their ability to hike and cut rates, and obviously that's really important, but I feel like what gets a little less shine is just what they're doing with their balance sheet. And we're in a period of time that's more similar to the green line in terms of quantitative easing versus quantitative tightening. And what you're seeing is average yields in the 14 years prior to the global financial crisis. So during that time period, there was no quantitative easing. The Fed wasn't just buying huge volumes of assets that was artificially holding rates down across the curve. We're seeing a time period now where the balance sheet has increased a ton from a treasury standpoint, I want to say around 7 trillion to around 25. And now there's the chance that there's a roll off of around 60 billion in treasuries. And I want to say maybe 95 billion in assets in total. And we think that, that's, a huge magnitude. And if investors don't pick up those yields because they think, hey, maybe inflation's too high, and even though yields are high, we still are demanding higher rates. It's to be determined, but those reasons are leading us to believe that rates are going to continue to stay elevated going forward.
Tom, what if indeed the Fed tightening does lead to a recession? Then it seems that with the downward sloping yield curve that there's already some recession expectation potentially built into bond prices. So how does what you just said, that you think interest rates will stay high, relate to this other idea that if there's an economic slowdown, then interest rates might come back down?
Yeah, I think that's going to be one of those situations that we're just going to have to see the data develop as it happens, because as I mentioned previously, the 10 years not driven just by hiking, cutting alone. There could be a slowdown, but maybe inflation does decrease a little bit and investors are comfortable with that yield. I think there's just a lot of factors going into that. Moving forward, I'd like to talk about our rent is coming due theme. And this is really just the idea that monetary policy decisions affect economic data, but they'll happen on delay, right? So we're seeing all these different tightening cycles. That purple dotted line is the most recent one, and we're seeing it's moving at the fastest pace in modern history. We've heard that time and time again, but even so, it's still taking a while for us to hit the economic data. The housing market, in 2022 is ground to a halt. Interest rates increased a ton. Normally when that happens, there's that inverse relationship between housing and interest rates, but those housing prices haven't come down as much as people would like. So houses aren't quite as affordable. And then what about the other pieces of the inflation puzzle that many people are focused on with the labor market and the consumer spending picture? Those also take a little time, a lot of time in some instances, to hit the economic data. And anecdotally looking back, this is quite a different tightening cycle than before. We had COVID happen, which is once in a lifetime kind of event, and many people lost jobs during that time period. But it seems like what has happened after is hiring has become difficult. Anybody who's hired somebody on this call has known it's really challenging. You get resumes from everywhere, and if you hire the wrong person, it could really slow down your business. If you hire the right person, 1 + 1 = 3, right? It's such a game changer. So after people lost jobs during COVID, people in companies were saying, hey, we can't be just getting rid of people because hiring quality people is going to be such a challenge. So I think that's one factor that's going into this really tight, really strong labor market. Another factor many economists have noted is immigration has really slowed down in the last decade, the last 5 to 7 years. People have, the opioid crisis is reducing the labor force. So there's a lot of factors, but there's a lot of job openings, and they really happen on delay. So looking at this chart on the left, again, every tightening cycle we see is different, but on average, it takes almost 2.5 years after a tightening cycle begins for unemployment to even start trending towards the peak. We started our tightening cycle at the beginning of 2022, and we're at the lowest unemployment rate since I think somewhere in the 60s, 1961 maybe. And then what happens, like how long before it actually peaks? And this says on average, each of these tightening cycles, it's been 1.5 years after the tightening cycle. So that's one very important piece of the puzzle, because if people have jobs, people are spending money, and that's keeping upward pressure on prices. We're seeing in the headlines, people in technology are losing their jobs, some financial services, but overall, we're still seeing a really strong labor market. And that's really helped fuel consumer spending. And again, this is happening on delay. So this table on the right shows that there's a 9-month delay on average before consumer spending starts to head towards that trough. And this past earnings season obviously wasn't great, but a lot of the credit card companies, for which I followed, none of them were really worried about the consumer spending picture. And then months after the cycle start, when it bottomed, could be almost 3 years. So it doesn't really seem like that's budging. So to me, that says, I think, monetary policy will eventually start impacting these data points, but anybody that's expecting that anytime soon may be sitting there holding their breath for a while. So how does that affect the equity picture? What do we expect from equities going forward with those interest rate and rent coming due themes? And I think it's important to look at the 3 components of return for equities. And dividend yield we can expect with a reasonable amount to be within that 1.7% range. Valuations, we think this is really strongly tied to the higher interest rate environment. So we looked at that 10-year slide and the change in 10-year during tightening cycles, and all those scenarios we saw the 10-year increase. We looked at all the tightening cycles for which we have valuation data, and 11 of those 13 tightening cycles in the back half, valuations have contracted in all but 2 of the 13 tightening cycles that we visited. In the 2 that we saw valuation expansion, it only expanded by 2%. And then just looking at this regression scatter plot on the left-hand side, this is essentially saying that the 10-year interest rates explain about 40% of the variability in PE ratios. So if we don't expect much from valuations based on our interest rate views, kind of looking at history, investor expectations, what do we think from an earnings standpoint? So earnings, we think, we just saw the Q4 season go through and obviously struggle. Seems like all the companies are trying to, spin zone what's going on and say, hey, we're trying to be more efficient, cut costs, and it seems like there's a lot of negative guidance going forward. So we expect these restrictive rates to kind of weigh on earnings the rest of the year. And the bottom right table shows what is our expectation? What have expectations been at the beginning of the year? That 5% earnings growth with a flat PE ratio, you're seeing low single-digit returns. Say there's a rosy scenario where the soft landing happens, inflation starts just going down like an elevator, and that's not really in everybody's picture anymore, and we get double-digit returns. We really find those scenarios unlikely, and we think that there's portfolio implications that people need to consider with these low equity returns. And one of them is a global diversified portfolio. So we think this is a very important chart for long-term investors to focus on. And what you're seeing on the left-hand side is what many consider the lost decade for investing in the S&P 500. And that lost decade is for investors that have only chosen to do home country bias for those US domestic investors. You would have actually lost money in your equity sleeve, right? But how do you choose what percent of which equity region you should be in? And we think this is why it's important to diversify your portfolio. If you diversified your portfolio with the weightings of MSCI ACWI, for example, you would have at least kept your portfolio positioning above the starting value. And then looking at the next 10 years, if you were to diversify again, you wouldn't have quite as much value of your portfolio. But that's the problem, is nobody has a crystal ball. Everyone's saying, what's the best time period to invest this? And there is some merit to tactical asset allocation, but diversification over the long term is really shown to be a winner. So
does Innovator ETFs have a view currently with regard to how one should weight their global equity portfolio, like what tilt away from the US, like 1999, or toward the US?
So we are, as somebody that's heading up the portfolio solutions, I deal with different portfolios every day. And what I typically do is I sit with an advisor and say, okay, what is the investment policy statement of your client? What is their risk? What is their return? What is their tax situation, time horizon, liquidity, any unique circumstances? Make sure I understand fully all those scenarios, just like we learned in the CFA level 3, and say, okay, does this person have an international mandate? Do they have an emerging market mandate? And we make sure we're hitting all those. We definitely, if they don't have those type of mandates, we recommend a globally diversified portfolio because of situations like this. So that's definitely a consideration when we're constructing portfolios.
Yeah, one thing that might be worth pointing out, since this slide is up, is that the left-hand chart that starts in 1999 is started at the time of the dot-com bubble. And so we know that US equity valuations were extraordinarily elevated relative to the rest of the world. And then the subsequent decade, the US stock market was trailing. We might look at 2021 as having some parallels to 1999, where the valuation difference between the US market and non-US was also historically high.
Yeah, that's a great point, Ken. We really like to look at statistical analysis and starting PE values versus long-term returns. I don't remember the numbers off the top of my head, but I want to say starting PE values versus like 5 and 10-year returns have an exceedingly large amount of predictive capabilities. So I think that's a great thing to point out. So with all of our outlook views kind of condensed and explaining how Innovator products work, I want to get into what the portfolio implications are and just kind of clear up some of these. So, as we discussed in the last theme, we expect muted equity returns. So slowing growth is likely to produce muted equity returns. We think there's recession risks that are remaining, and for that reason, there's also diversification challenges. But what do we do about those muted equity returns, right? So we think that you need to seek strategies that can accelerate positive returns, but with built-in risk management. And you may be thinking, how would you do that? We discussed earlier, there's no free lunch time. Those buffer strategies that you mentioned earlier, you have to sell an upside cap to fund that downside protection. But we also have accelerated strategies that work a little differently, where instead of selling that upside cap to fund the downside protection, we sell that upside cap to give you double the upside exposure over an outcome period. So, since 2009, there's never been this much dispersion with, investment banks expectations for, the S&P 500 outlook. Many of them are floating in that low single-digit return expectation area, but some accelerated strategies, using these simple options payoffs might be a good idea. And we have indexes that we've created going back with Mercube, and the option nature of these type of accelerated strategies actually reduce the volatility despite hearing the name accelerated. So I would explore those in low single-digit return environments, because in an event like 2022, where you look at a quarter-by-quarter scenario, an accelerated quarterly strategy would have lost about the same amount as the S&P 500, but in the fourth quarter would have added a lot of value. So that's something we think is important to consider. And then another portfolio implication is diversification challenges. So we're looking at bonds and equities having significantly correlated return scenarios. So we use diversification. We talked about global diversification. Diversification with stocks and bonds is really important. But what happens in those times of financial distress where, hey, these assets are really correlated? And in 2022, we saw negative double-digit returns from both bonds and stocks. This is a scenario where buffer strategies can really come into play and prevent you from losing a lot of your portfolio. So relying only on fixed income alone, I think, would be a mistake going forward in these scenarios. And then finally, pursuing alpha. This kind of goes hand in hand with our muted equity returns and consideration for accelerated strategies. But we were going through a bull market for a while where we had a situation where the Fed was pumping money, interest rates were really low, and that was really rising the tide on all asset classes. So seeking strategies like these accelerated strategies might be a good idea to consider in low return environment scenarios. And then before we get a little bit into the questions here, I'd like to introduce Bennett. He actually handles the Pacific Northwest, and I just want him to introduce himself in case anybody has any questions on these strategies as they become more popular and staples in portfolios in the future.
Yeah, thanks, Tom. Thanks for the introduction there. As he said, my name is Bennett Fair. I work with Tom and actually cover the Bay Area here as an advisor consultant in that capacity for Innovator ETFs. And I just wanted to briefly introduce myself as an extension, as another resource in addition to Tom here on the call. And even beyond today's call, if you have any questions, feel free to reach out, find my information on the website. And with that, I'll switch it back over to the Q&A time. We have a few that were sent in earlier, and we'll even take some of the live ones as well.
All right, I'll kick that off. For those of you who have joined us this afternoon, there is a chat box in the call, and we welcome you to add your questions there so that we can address them to Tom while we are together. I'll throw in a question to start. Tom, your firm offers a suite of downside protected strategies. So you get equity exposure. If equities go down, you'll lose less than if you just own the equity index. Is your belief that investors should always have downside protection? Or do you think that given the heightened uncertainty in the market today, that this is one of those times where downside protection makes sense?
That's a great question, Ken. And, I think that really goes back to that investment policy statement that we talked about, hitting all those points, like what is an investor's risk, return, time horizon, liquidity needs, all those kind of things. And where we're seeing people really like our strategies is people towards the end of that time horizon who don't want to have to remake that nest egg by losing all their money. But in terms, the way I look at it is, just taking a step back, right? So people that do, a 100% equity portfolio, we'll say, for starters, right? You probably have a long time horizon. You're not too worried about equity drawdowns. You'll be able to make that up as, you advance through your time horizon. But if you had, a risk concern about that, maybe you would have a 50-50 portfolio instead of 50% stocks, 50% bonds, because you don't want to take on that risk if there are those equity drawdowns. I look at this the same way as if you're an investor or a foundation that doesn't want to lose a certain amount of money, I would highly consider keeping these in your portfolio at all times, because even though you may give up some of that upside, sometimes these equity market drawdowns can happen rapidly. It seems like as time goes on, they're happening more and more rapidly. So I think it really depends on that risk measurement that you're looking for, but I think it can be a long-term holding depending on your risk appetite.
It looks like you folks at Innovator have done a lot of the investigation of the financial market history, the impact of Fed tightenings, et cetera, and the relationship between tightenings and recessions. Is there a house view about how the rest of this year plays out? The likelihood that we will have a recession, the expected outcome for the stock market, and so on.
Yeah, so our expectation based on all the data that we have now is that it's going to take quite a while before inflation starts coming back down towards that 2% target. And with that rent is coming due theme, we do believe it's coming due. And if the Federal Reserve doesn't tighten enough to bring the unemployment rate higher, then we're going to be dealing with inflation for a long time. So I'm of the opinion, and I think us at Innovator would say we believe a recession is coming. It's probably more likely to come in 2024 than 2023. But with the bumpy ride expected with these inflation prints, we think it'll be a real push-pull type market for the rest of 2023. Our research has shown that that push-pull during CPI and PPI releases, CPI specifically, seems like there's been a range of 2.4% return from the daily open to daily close, daily high, daily low of those CPI dates. And I think that's just really indicative of the type of market that we're trying to front run any potential pivot by market participants, but I don't think that's going to happen anytime soon.
All right. We did get a question ahead of this session about liability-driven investment strategies. And the question is, how is the inevitable increase in bond yields affecting LDI strategies, and particularly if yield curve slope normalizes, that is, we go back to the normal positive slope? Did you want to take that one, Tom?
Yeah, I could take that one. And given I would say that's not really in my expertise wheelhouse on liability-driven investment, but I think given the higher bond yields moving forward and the inflation expectations with the higher bond yields, I would expect that to discount the liabilities further, but there's going to be that kind of balance where inflation is pushing those liabilities higher. I think that'll be a challenge with the short end. The short end higher than the long end. So I think you might have to take riskier assets in your covering your liability approach.
Yep. I could throw in a comment, if you don't mind, on LDI as well. So LDI, typically the pension plan has known liabilities, they discount to the present value, and so their funded status is based on the discount rate. And to manage funded status risk, then an LDI strategy would basically own duration, like long duration. Last year was a year where long duration was a money losing strategy, and I believe indeed there was kind of a crisis in the UK because LDI is commonly practiced in the UK with the rise in rates in the UK that pension plans experience relatively large losses. So for someone who's thinking about LDI, if you weren't hedged before, then luckily you missed out on the losses you would have experienced from the rise in rates that happened in in the last year. And then you have an interesting choice that we've talked about today, which is, well, if you think that rates are about the top or close to the top, then you might want to increase the amount of hedging you do. I think Tom's data that he presented indicates that the peak in yields tends to happen around the end of the tightening cycle. And so that could be a time to hedge more. If we do go into a recession, as many expect, then that could be a time when LDI, the LDI part of the investment strategy starts to gain again. We have another question from the audience, and this one, the question is like, how bad are the risks of complete wipeout of certain international investments due to expansion of wars? I think we did experience last year basically the disappearance of the Russian equity market for all intents and purposes for Western investors that had positions in Russia. We're still waiting for something to happen with those. Tom, do you have a view on that with regard to sort of other equity markets that could have some geopolitical risk associated with them?
Yeah, we definitely, on the positive side, people are saying, hey, China's emerging. China's, one of the main drivers of MSCI emerging markets, which we follow as we have a strategy on. China's reopening from the strictest lockdowns. Some of the regulations are decreasing a lot. But you look at some of these time periods and emerging markets have really struggled. And due to that, we really think that it might be a good idea to still diversify, but using a buffer strategy. I personally feel like there's a lot of risk geopolitically in that side of the globe, and buffering your potential exposure may be a good way to calm down your worries about that.
Mm-hmm. One of the issues that people have sometimes with strategies that have embedded options is it can be challenging to know if you're getting a good deal. Not many of us are experts in option pricing. And so if you're not an expert in option pricing, then how do you know like what's the fair value call that you would get for buying a put to finance a put spread? Do you have guidance about that? As we evaluate your strategies, which are more complex than the typical run-of-the-mill ETFs, how could an investor get comfortable that the deal they're getting is a good one?
Yeah, I would say that we use history as a guide because, I went through the CFA program, learned about alternatives, learned about futures and options. I went to U of I, took a class on it. Before I started Innovator, I would say that I'm far from an options expert. I learned the basics of understanding. We've partnered with a company called Milliman, which is an actuarial firm that really works to price these options for us. So I personally, what I do is as I mentioned time and time again over the call, is look at what are we doing from a historical standpoint? How much has the MSCI emerging markets over a 12-year time horizon passed our upside cap or went down below the buffer? That's what I personally do. But anybody that's interested, I could give them more material on how Milliman does what they do and make sure they're ensuring the best pricing.
All right. We're almost out of time. We don't have more questions for the audience. I've thought of another question, but if Tom, if you'd rather spend the last minute with presenting some parting thoughts, we could go with that.
Yeah, feel free to answer your question.
Okay, so you are an active issuer of ETFs. I think there's look like dozens of ETFs now that you are offering to the marketplace. The ETF market has just grown like gangbusters over since the creation of the industry. As someone who is like an innovator, a new growing firm in the space, I'd be interested in your perspectives on what's happening in the ETF market. What are the sort of the major trends, the developments in ETFs in general, and how you fit in with that?
Yeah, I would say, this kind of goes back to my introduction of Innovator to begin with. And I think we're seeing people really look at us, and we're innovating with different ideas that are, almost creating hybrid asset classes. And I think people are looking to find ways to still provide value that isn't out there, because how many S&P 500 funds are there? How many emerging market funds are there? There's not a ton of people with these buffered strategies or unique payoff profiles. So I think people are still saying, hey, there is still ways to innovate in this market. And one of those examples are we're coming out with these barrier defined income type of strategies at the beginning of April here. And, people are always looking for yield, right? We had that liability driven investing type question, and people are looking at, fixed income, aggregate bonds, high yield bonds, high dividend type of ETFs, real estate. But we're coming out with a barrier ETF that provides a level of downside protection at 4 different levels: 10, 20, 30, 40. And again, we were using history as a guide to create these. So just giving an example, the 40% barrier reference asset is the S&P 500, and the payoff profile is you essentially use options that you sell to invest in short-term treasuries. So you get the treasury income and the option premium, and as long as the strategy doesn't decrease over 40%, you get that income. So it's essentially an income type product strategy. And it has that downside level protection. But if you go over that barrier, you lose the whole 41%. So you kind of have to weigh the risks, but I think that'll be an interesting strategy going forward.
All right. As we were talking, we got one last question from the audience, so I'll pitch that in. The question is, what are the benefits of using a deep in the money call instead of the underlying as the base layer? So I think the idea here is you could go long the index by buying a deep in the money call, and so you'd still get the upside participation. You'd still have some downside limitation since you wouldn't lose anything below the call strike. So how do you think about that?
Yeah, that's the idea there.
Well, how would you think about that as I guess in relation to the sort of put spread collars that are the mainstream strategies that you offer?
Part of the reason that the options packages are so cheap is because they're kind of purchased as a package. So I think that's part of the cost decrease, is having them all together rather than buying, the 3 and then having just the underlying S&P 500 one. But again, that's something I could get more information from Milliman to provide.
All right. Well, I don't see more questions from the audience at this time. We've gone a little bit over. Thank you very much, Tom, for your remarks and insights about what the Fed is doing and what it means for markets. And thanks all of you for joining us today.
Thanks all.